Ashok Kumar, thank you very much indeed for doing this. Now, why did these two companies, why did they want 3PAR so badly?
I think it was more strategic than financial on a near-term basis. It does give Hewlett-Packard the product portfolio to compete at the very high end of the storage hierarchy against the incumbents, which are EMC, IBM, and Hitachi. Financially, of course, any which way you slice this transaction, it is extremely expensive at 10 times forward sales versus peer group EMC and NetApp's in a valuation of 2 times sales.
Ashok, isn't it a case here that you could say that part of the reason here is HP buying 3PAR in order to keep Dell in the poorhouse here and, in fact, stop Dell from buying a company that could really help it?
Yes, I think that is one line of thinking. While the high end of the market, which is sized anywhere between $6 to $8 billion, is a slow growth market, it's very profitable as measured by even 3PAR's gross margin, 65%. So this would have helped Dell improve its profitability structure on a longer-term basis.
Is there another company that could provide Dell with the same sort of stuff?
Not on a pure play, smaller cap side. I think the companies like Compellent and Isilon, but most of them are at the low end. And Dell, of course, has acquired Ecologic for $1.4 billion, which provides them the presence in the low end of the market. So it's very likely that this essentially is a small setback near term for Dell, and they'll have to go back and rebuild the channel relationship they have with EMC.
Just want to get on to, the pricing here and the valuations involved. Does 3PAR in any way justify what they're getting?
Absolutely not. I think, it's in excess of $3 million per employee. And to put it in perspective, today, 3PAR has about 5% of the very high-end market. And for these premiums to pay out, Hewlett-Packard would have to expand that market share to about 25%, or about $1.5 billion, which is 5x the projected growth rate. And all of that would come at the expense of the incumbents, which is IBM, EMC, and Hitachi, because it is a zero-sum game at the high end.
We're seeing quite a lot of mergers and acquisition activity at the moment as far as technology goes. What's behind it?
I think, looking back, you have Intel taking out, McAfee for almost $8 billion, Intel acquiring Infineon's wireless business to give them a toehold in the smartphone segment. I think the net is, I think, the rise of this one-stop shop where these larger companies continue to consolidate and cement their position in key end markets, whether it's consumer or enterprise, and the demise of these best-of-breed point product and solution companies. I think so. Stepping back, you also have Oracle's Larry Ellison setting the pace the continued consolidation both in the software service side and then the hardware and the component companies doing the same.
Ashok, doesn't it concern you that these U.S. companies which have a lot of cash are using it to get involved with, perhaps one could argue, risky mergers rather than actually investing it in R&D and development and indeed organic growth?
Yeah, that's a very good point, because under, I think Hewlett-Packard is a poster child for that. Under Mark Hurd's tenure, the company was famous for cost cutting, but they never spent the research and development dollars to build out their portfolio organically. And so this is a big disservice, and we see that happening across the board. So on the bright side, of course, there is a liquidity premium or a takeout premium for these smaller cap stories, but it also reflects the maturity of the technology landscape where organic growth is going to be difficult to come by.
Ashok Kumar, thank you very much indeed for joining us. He's from Rodman and Renshaw.